European Central Bank has raised interest rates for 8th successive time. It is expected there is a policy tightening as countries, European Union, European Central Bank tries to get a hold on high inflation. Karthik, inflation of course is a big story here. Recession, inflation, and Eurozone to Germany to US, everybody talking about inflation, essentially in common man's parlance, mehengai. Everybody's battling with mehengai.
Yes, Shweta, and that's the reality of the times that we live in. And unfortunately, we've seen what has happened in the world over the last 2-3 years, and it's not funny. I mean, you've seen a once in a lifetime, once in a century pandemic, which wiped out economies and economic interests of countries fairly squarely. Add to that, now we are more than a year and a quarter into the Russia-Ukraine war, and that's hit global supply chains like never before in recent memory, recent history. So overall, you've seen the world's manufacturing factory, China, taking a beating, the zero COVID policy sort of slowing down operations in the country and the export that the country made to other countries drastically. At the same time, there is distrust, mistrust that the world has on China, due to which it's looking at partners outside of mainland China to procure their goods from. Then there is a fuel crisis in the world with the Russia-Ukraine war and the West imposing sanctions on Russia for and hence not importing oil from there. So overall prices have gone up. There has been a shortage of supply. There has been a situation where prices have gone up because of the world's factory slowing down operations, and people not wanting to buy from that factory, and at the same time rising fuel prices. A zone within Europe, squarely in the middle of a European war, supply chains hit across the world, air routes hit. So we've been in a situation where there is bound to be a rise in prices, and that rise in prices is purely what we are seeing today as inflation. Now, this inflation has got very, very serious ramifications, because you can't let prices rise endlessly. So central banks become very important cahoots here, who come and tinker the monetary policy, tighten rates. Now, why do you tighten rates? You tighten rates because you want to, you increase the interest rate, because that is going to give better interest to people who park their money, citizens who park their money in banks. Now, how does this help? This helps because by putting that money in a bank, liquidity is sucked out. So your demand reduces. You don't have enough money in your pocket. You've put it in the bank because that's giving you a good interest rate. So you don't have enough money to go out and buy goods. So you've curtailed demand artificially, while supply was anyway hit. So the equilibrium is met at a much lower price point. Now add to that, banks themselves get flushed with liquidity infusion. So they don't have to print currency. Right. And they can continue buying whatever necessities that the government has to spend on. Those bonds can be bought. But the other side, the darker side of monetary tightening is that as interest rates rise, even the loans that banks give out become expensive. And not just home loans and auto loans and personal loans here. I'm talking about corporate debt. So corporate debt becomes expensive. As corporate debt becomes expensive, companies slow down on their ambitions to leverage themselves for higher growth. They say, here, let me wait for the interest rates to cool off, and then I should go to my bank and pick up some loan at a cheaper cost of capital. So overall, the economic activity takes a hit because money has come out. There aren't enough people going to the market and buying. And at the same time, supply is also a hit because companies are not leveraging themselves, taking loans from the banks and deploying it back in their operations to produce more and more. And as a result of that, recession.
All right. So thanks for explaining all of that formula. Essentially, Amit here would also be coming in on this story. Amit, it's interesting dichotomy that's playing out, and that is central bank, European Central Bank continues to hike interest rates. mainly, as Karthik pointed out, to contain inflation, and essentially an artificial way of containing inflation here by tightening the monetary policy. At the same time, China is doing the opposite. For the first time in 10 months now, it's cut rates.
Yeah. So it's a tricky situation. In Europe, in their 25-year history, this is the steepest raise in interest rates, and their inflation, even though it has moderated due to leveled due to moderating energy prices, is still at 6.1%. They are targeting around 3% for 2024 and still over 2% for 2025. First world countries, you're in the habit of seeing 1% inflation rates. They're still very high, and these are projected right now at 6.1%. And that's a tricky situation. You are deflating the economy by sucking out money. So people have less money in their hands, to put it very simply. They're spending less, manufacturing goes down. China is doing the opposite. They are trying to basically put money in the hands of people, what we call pump priming sometime, and basically kickstart an economy that is shrinking. Their base is manufacturing. They can't let their manufacturing go down. That is my understanding of why China is doing it. And so it's a tricky situation, like you say. And China is still basically, it's first world, but it has a bigger market. So they need to do that. So that is the difference between basically what Europe and America are doing on the one side by basically sucking out money, and why China is doing this, because their base is manufacturing.
Okay. Very interesting, and I want to understand this further from Karthik at this point, and for my benefit as well. Karthik, China is still, the inflation is still hovering over 6%, as Amit pointed out, which is in Europe and in China also, the inflation is high. Despite that, they are cutting rates, and that would not make any economic sense. Why exactly is China doing it?
Okay, so bear with me. There's going to be a slightly longish answer. Now, China is a very interesting place to be in, right? And I'm not sure I mean it without pun, because China has this beautiful advantage that between 1994 and 2005, if I remember, the Chinese yuan was pegged to the US dollar. 2005, China decided that it's not going to peg its yuan, its currency, against the dollar, and it's going to have a floating exchange rate, which means China is free to monetize as much money, mint as much money as it wants, without it having any ramifications on the yuan's price against the dollar. Now, adding to that, what Amit said absolutely correctly is that China's base is manufacturing, and that is its real competitive advantage in the world. Now, how does China offset this inflation and recessionary pressure? It does it by incentivizing its manufacturing sector to become even more competitive. And how does it become even more competitive? By banks willing to lend more at a cheaper rate to its industries. Now, as there is going to be more credit offtake in China, it will be able to produce more and more goods in a hope to export that to the rest of the world. Now, exporting that to the rest of the world, in the case of China, has got two advantages. Number one, the volume of the exchange goes out. And number two, it is up to China to peg the yuan at whatever dollar price it deems fit, without really informing the world that it has perhaps, circuitously gone ahead and printed more currency. So maybe it has done quantitative easing, maybe it has done, remonetization of the economy to put more money in the hands of the public, to put more money via interest in the hands and loans in the hands of its manufacturers, and yet keeping the beautiful floating yuan exchange rate intact and raking in more US dollars.
Okay. So essentially, correct me if I'm wrong, it makes sense for China to do it because it is essentially a manufacturing economy.
And a floating currency.
Yeah. And has a floating currency.
Yeah. And there is a social aspect to it also. China was the most populated country till few months back. They are number 2 now to India. They have a huge population. They can't let that population be unemployed. Right now, their unemployment rate for the ages of 16 and 24 is at a record high of 20%, 20.8%. Total unemployment is between 5 and 6%. So they can't let that happen. They have that thing to take care of, because as we all know, idle people, idle youth leads to basically unrest. So they have that thing to
Okay.
take care of. Also,
There.
that's the social aspect of why probably China is putting money back into the economy.
All right. So the interesting dichotomy there between what China is doing and the rest of the world, of course. India has paused a hike in rates in the latest Monetary Policy Committee meet, but China, they're cutting interest rates for the very first time in 10 months. We will keep tracking those details.